Good evening, everybody. Tonight on Bond Squad After Hours broadcast, we're going to discuss the good, the bad, and the ugly from today's FOMC meeting. Before we get started, we'd like to give our usual disclaimers. This is brought to you by Wealth Strategies and Management. Wealth Strategies and Management and Bond Squad are separate entities from Private Advisor Group. Private Advisor Group is the firm in which we do our portfolio management, our registered investment advisory service. Today was definitely a day of good, bad, and ugly. The good is that the Fed meeting is now behind us, and we have some clarity on what the Fed is thinking. The bad is that the Fed lowered its guidance, and that kind of took the markets by surprise. The ugly is that investors, market participants, and unfortunately, an increasing number of investment firms managed portfolio units don't get it. It's ugly. It's just a lack of knowledge. So let's go through the Fed's commentary today. All right. Fed Chair Yellen at her press conference stressed that just because patient was removed from the Fed statement does not mean the Fed will be impatient. In other words, the Fed is not obligated to move rates anytime soon. The Fed lowered its longer run full employment range to 5 to 5.2 from 5.2 to 5.5. Now that's important because NARU, the naturally occurring unemployment rate, is the rate at which theoretically wage growth or job growth neither adds nor subtracts to inflation. Well, as we suspected, that number is lower than before. We think the number is probably in the mid fours. Now we take comfort in the fact that the Fed keeps lowering their outlooks and their NARU rates and their interest rate forecasts, which we'll get to, because they're coming to where we have been for a long time. Basically what the Fed did was it said that it's no longer necessarily patient, it is data dependent, and then it lowered the outlook for the data. So those who wanted to see the Fed as hawkish, and there are a few people out there, I don't think they know what they're talking about, but went out there and said the Fed's clearing the way for interest rate hikes. In theory, they're probably right. In practice, what they did, they hitched their wagon, as it were, to lower data forecasts. So now we're not patient. We're going to go what the data tells us. But you know what? We don't expect the data to be indicative of a rate hike. Now, this is important because we're probably going to have a fairly weak Q1 GDP. When everybody was tracking 3 going into this, we were like 2.5, 2.7. Now it looks like it's tracking at 2 or maybe even lower. So we're going at 2. It's tough to figure that out because of the weather, and that plays into where I'm going here. The Fed probably wants to see a quote-unquote clean quarter before raising the Fed funds rate. That means it would probably want to see the final data from Q2. Unless there's a huge spike in the preliminary data that would send bells off and alarms off at the Fed. For that to happen, it would have to wait until the final data, especially GDP, remember it gets three revisions, 3 looks, that would come in September. So they would have 2. They wouldn't have the third one, I don't think, by that meeting. They'd have 2 of the 3. And most of the other final renditions of Q2 data in September. So we were predicting here at Bond Squad a Q3 or a September, to be more precise, liftoff of the Fed funds rate. We still think that's our base case. It might end up being even the soonest that the Fed might raise the Fed funds rate. And when we say raise the Fed funds rate, we're talking about going from 0 to a quarter. And the Fed, the dots, as it were, the estimates, the aggregate estimates by Fed officials put the year-end Fed funds rate at 5/8 of a point. That's 62.5 basis points, down from about 1 1/4 at the last meeting. So the Fed is reining in their scale. They think growth goes in the mid twos this year. They don't see inflation coming back up to their 2% target until sometime early in 2018. Ms. Yellen also stressed that interest rates on all parts of the curve are probably going to be less than they had been in the past, and that the peak Fed funds rate will probably be lower than peak Fed funds rates of the past. Bond Squad thinks that we might not be above 1% by the end of 2016, never mind 2015 on the Fed funds rate, and that the Fed funds rate might peak in this cycle around 2.5. Again, we would not be shocked if, when the yield curve does eventually go flat, or as flat as it's going to be in this interest rate cycle, in the next rising interest rate cycle, that all rates are below 3%. It could be that, all rates except for the long bond are below 2.5. Since the long bond's at 254 right now, it's even possible that the long bond, a 30-year government bond, goes below 2.5. We'll see. Now, this is throwing many investment models, modern portfolio theory models, into disarray, because things weren't correlated like this in the past. But this isn't the past. We never had the whole world almost engaging in a currency war to the bottom. Sweden went to a negative quarter-point overnight benchmark rate. Now, the Fed, by lowering its economic outlook data guidance and its inflation guidance and its interest rate guidance, has in effect, and there's a debate whether it's intentional, Bond Squad believes it was, to talk down the dollar versus foreign currencies. And we saw that. The dollar was at 105, it hit 110, I think it closed the day at 109 versus the euro. Now, anybody who thought the Fed was going to sit idly by or even raise rates while the rest of the world devalues and puts the U.S. economy at a disadvantage in the global economy. Remember, this is a global economy. We may be the most insular of all the large economies, but we're not completely insular, right? So the Fed wasn't going to sit there and say, oh, well, the unemployment rate is where full employment usually is, and even though inflation's low, well, we're just going to raise rates and take it on the chin because we have to be beholden to a number or a model or a theory. The Marines have a motto. It says, improvise, adapt, overcome. In most areas of life, especially in the military, that's considered to be a positive thing. The ability to think on your feet, to change on the fly, to adapt to conditions, right? Rather than just, plunge forward into the enemy's defense. Right? But on Wall Street, it seems to be, especially the last decade or so, to be a negative. The model says otherwise. We got to adhere to the model. Why? Because the model is well thought out by very intelligent people. Yeah? If I walk outside and it's pouring rain on my head, do I not put on a raincoat because the weatherman on television or on the internet said it was sunny out or supposed to be sunny out? Sometimes you got to adapt. And what we have here is a global economy that's far different from any global economy that existed when some of these models were built. And if you're going back to modern portfolio theory, well, some of those models were built in the 1960s. Maybe we should all, travel over to the theorists like Harry Markowitz, who we actually think is very bright, in our AMC Rambler, and sit around and discuss this. Oh, wait, they don't make AMC Ramblers anymore. Maybe we should just sit and watch our Philco TV. Oh, they don't make Philco TVs anymore either. TV dinners? Not so much. Things change. We have to change with it. So the Fed is acknowledging that. The Fed's acknowledging that with its lowering of its full employment estimate, what is full employment, and it's being criticized for that. We heard pundits today say, "Oh, the Fed is winging it." Who isn't? Who isn't? The models out there have blown up, tremendously. They haven't worked. These asset allocation models, correlation, they haven't worked. Economic models haven't worked. We see unemployment at 5.5. We have no wage growth. We have no inflation, right? Yet we have some consumption picking up, but not as much as low oil prices, might otherwise indicate based on what economic models. Well, if models weren't built when the U.S. was poised to pass Saudi Arabia as the biggest producer of crude oil. See, that might make a difference, right? And provide lots of jobs and income and wages, and that wasn't figured in. It has to be figured in. The Fed says, well, Ms. Yellen said she sees cyclical weakness in unemployment or in employment, evidenced by the labor participation rate. We think it's more structural than cyclical. The cyclical part of the labor weakness is probably past us. It should have by now, right? This is probably more structural. And I think the Fed knows that, but they can't come out and say that, right? What if Ms. Yellen got up there today on the podium and said, you know what? This is structural and zero rates can't fix it. She knows that's probably the case. She also knows that Congress or the president or anybody else is not going to do anything about it. She has to say it's cyclical, and that gives her and the Fed an excuse to keep policy, cranked up. And we're not complaining. She gets criticized for keeping policy jacked up. We would love to see a rate increase just to weed out the pretenders out there, just to have risk allocations go somewhat back to normal. But she also knows that the Fed right now in the United States, the Fed is the only game in town, and worldwide, central banks are the only game in town because no one wants to go to their constituents and say, the promises we made you for the last 50 years, we can't keep them. Your wage growth every year and your house going up, doubling in price every 5 years, not going to happen anymore. The economy's different. But, the models say it is, so we have to keep pretending that that's going back there. Not happening. The Fed also saw a weakness in GDP from lower exports and lower household spending. Some of that might be weather related, but we don't think that the weather plays as big a role in household spending as it did in the past, thanks to eBay and Amazon, and just about every retailer out there has online shopping. They'll deliver it to your home. You want to watch a movie, you can stream it. You don't even have to go to the kiosk at the mall or the video store in the corner. You can watch almost any movie you want and stream it. So the weather really doesn't play a big factor in it anymore, not as much as it did. And each year it's going to be less and less. What else do we have here? Oh, the Fed is concerned about the dollar pushing down inflation. Okay. Well, no kidding. A stronger dollar, it has to pull down inflation, because if a dollar buys more, that means the price of that good goes down. It can't let the dollar stick out. Now, in the Fed's defense, a few years ago, the Fed Chairman Bernanke was urging European leaders, and for a decade or more, Fed officials have been urging the Bank of Japan and Japanese policymakers to become more aggressive in their policy accommodation and pro-growth policies, and they didn't. So now the Fed was faced with a situation where these other countries waited too long. They had to come in and ease aggressively, and the Fed is past that point. So you have a disconnect in policy. And so now the Fed in the global economy, although it's the piper it calls the tune to an extent, can't completely have the dance party by itself, right? So it did kind of call the tune today. It said we're data dependent, but the data is not as strong as we thought it was going to be, and it's not. It is probably going to trend that way, and thus we're probably going to be lower for longer, even though she didn't say those words. You can infer that if the Fed says that we're data dependent, and then in the next breath says the data is probably not going to be as strong as we originally thought. Ergo, a little Latin for you, Fed policy is going to be very accommodative. And the Fed also said they're going to continue to reinvest the proceeds. That's the interest from the bonds they hold and the matured principal back in and buying bonds with it. Well, that's stealth QE, right? They're going in and they're still buying bonds, not shrinking the balance sheet. So when these payments come in, they take the money and they go buy bonds, mostly treasuries at this point. But that holds it down. So, that's where we're going here. The markets were shocked by it. The markets were convinced that the Fed Remove patience, going to start tightening. Why? Because things look so damn good. They're not that damn good. They're all right. And if you read the Fed's statement, they weren't quite as positive. It's not just the weather. The Fed isn't perfect. The Fed misses things, but the Fed isn't stupid. All right. There's more going on here than just the weather. Now, what we don't know is how much of the other Fed, how much was the weather, how much was structural. They don't either, and that's why they have to be flexible. The Marines have another motto. It's Semper Gumby. Remember Gumby, the rubber eraser character, which means always flexible in their lexicon. So, again, it's a positive there. It seems to be a negative in the financial industry. It just baffles us here. What else? The Fed also says wage growth recovery is unclear. And Ms. Yellen stated that it might not pick up. Remember, things aren't preordained to happen. Correlations don't exist just because. The U.S. is not preordained to go at 3%. Inflation is not preordained to go back to 2. Wage growth isn't preordained to go to 3. It takes decisions by consumers, policymakers, businesses, technology to make all these things happen at whatever rate they happen. So the Fed says no single factor. The markets were convinced. They convinced themselves that it's job growth. They're focused on job growth. They're focused on job growth. We've been writing inflation. You can't factor out inflation. It's going to be difficult for the Fed to raise rates while inflation is low. And not just headline, which is for oil, but core PEC is running at 1.3. Okay, there's not an inflation problem out there. The Fed doesn't see their core inflation going to 2 until 2018 rather. So where are we going here? We're not going anywhere. And this brings a strategy question. Everybody was pushing in rising rates. Even some people in my own firm, rising rates. Tom, we got to be ready for rising rates. I'm like, one, if the Fed does raise, it's going to raise modestly. 2, if the Fed does raise, that's anti-inflationary and in an already low inflation environment, that should hold down long-term rates, which tend to price towards inflation and global sovereign rates. And so we came into last year with the opinion that investors might want to, depending on their goals, objectives, and risk tolerance, they might want to take on a little more duration risk instead of credit risk to enhance returns. Well, that we were looked upon as somebody spiked our coffee here, okay? But nobody spiked our coffee. We understand the fixed income markets. Most of those opinions contrary to us were portfolio managers who were discussing the fixed income part of the overall strategy, their pie chart. Whereas at Bond Squad, we are fixed income managers who discuss the fixed income markets, fixed income asset classes, fixed income trends. Okay? We do not just look at a model and say, well, this is how it's always been. I'm Tom Byrne, not David Byrne. I don't. My motto isn't same as it ever was. It's never same as it ever was. There's always a change. And right now we're going through what we think here at Bond Squad is a transformational change in the global economy. So that's why these models, look, we have readers who've come to us and say, Tom, we like what you're saying, but it's hard for us to do things when what you're saying is the opposite of what our firm is saying. And their firm is not their fixed income strategist, by the way. Their firm is their managed portfolio department. And I've read the reports out of some of these departments. They're cheerleading, positive, and based on models, and they'll put out any historical data, to make their case. They'll cherry pick it. But they know it seems that they know as much about fixed income as I do about brain surgery. In fact, I probably know more about brain surgery than they do about fixed income, but that's an argument for another day. So it's blowing up these models. It's blowing up these estimates. It's funny, though, the fixed income guys out there, The real fixed income guys, the Mike Brandises of the world who recently left Citi, the Jeff Gundlachs, the Peter Bookvars of the world, the Ray Dalios, they haven't been that different from us if you notice. They haven't been. The real fixed income guys get it. And they're hauled on television all the time. Oh, look at the contrarian opinion from this weird bond guy out there. Weird bond guys have been right. We didn't buy into the invest overseas for the long term. Yeah, we thought there was a trade to be had in German stocks, for instance, and even in Japanese stocks to an extent based on the QE. But we thought it was a short-term trade because it's a monetary policy based increase in asset price. There's no structural foundation for it unless the U.S. sits by and lets its clock get cleaned by not adjusting policy, or by adjusting policy to be tighter. Well, now what happens? The Fed jawbones the dollar weaker, $1.09 now against the euro. Draghi's probably not too happy about that. Shinzo Abe in Japan is probably not too happy about that. Are they going to sit by and let the Fed just weaken the dollar? Look for them to jawbone the other way. Look for more, you will do whatever it takes comments. Look for comments that we can increase the size of QE. And look for those who are long those European and Japanese stocks to try to talk their books. Now, we do think that the euro goes to parity versus the dollar, and probably a little bit through it into the 90 cents, maybe even high 80 cent range. But now, if you're jumping in the market and looking to hedge, well, the hedges cost money. And it's not understood out there what we mean by that. It means the cost of the vehicles to provide a hedge might outweigh the benefits of the hedge from here to where the euro ends up versus the dollar. Back last summer when the euro was at over $1.40, the hedge made sense. When it was $1.20, the hedge makes sense. When it's $1.05 to $1.09, does that make sense? Depends on what the hedge costs you, right? Hedges aren't free. If you're hedging for a likely outcome, the other side probably thinks that the outcome is likely. It's not that he has an opposite opinion. Not everybody who takes the other side of a trade has a truly opposite opinion. They just look to lay risk off, right? So they sell you protection, and then they buy it somewhere else and work for the VIG in between. Now, somewhere along the line, somebody has an opposite opinion because it's worth it for them to take an opposite opinion. If I'm getting paid enough to take the risk, I'll take the risk to be the contrarian there, right? So I charge you more for that hedge. Now I'm getting a little wonky here for those of you who are a trading background, and I'm trying to make it very simple here, maybe too simple for some of the professionals that are watching this, and there are quite a few who do watch this, including subscribers who are professionals. The hedge might not make sense at this point if you're going into Europe. And this is a currency war. This is a race to the bottom. The Fed has entered the race. Now, it's still maybe a mile behind, but it's in the race. And, we just don't think that long-term rates are going very far. We think a quarter point in September or a quarter point in December, not necessarily and if it is it's 1 and 1, and they missed that interim November meeting or end of October. I can't remember if it crosses over something off the top of my head. I can't remember when it is. And then maybe wait until next March for the next one, or not, or wait. Maybe they wait till June, and then another one in December of 16. They get you 1%. Fed fund futures have come down. They were pricing like 1.25 out there. Actually 1.5 at one point. Now they're down to about 1.25 last we looked. In fact, let's check the Bloomberg here. Let's see. I'm not taking up too much time here. Where are we now on the good old Fed funds futures? I can't get it going right now, but I did see it. I think it was down to somewhere around 1.25 now for that. Now, we don't think rates are going very far, and What does it do for your floaters? Well, your floaters probably aren't floating, right? What you have is anchors. They're stuck to the bottom. And some are below minimum coupons by the calculation. So you can see a 100 basis point rise, 125 basis point rise in LIBOR, which is joined at the hip of the Fed funds rate. And we explain that in our writings and one-on-one if you ask us to. You can see 100, 125 basis point rise in short-term rates before those coupons move a basis point. So the floaters aren't floating. So that's why we like floaters with the big floating spread. We want to be rewarded. But that's about that. Our outlook hasn't changed. We still rather take some duration risk over credit risk to pick up yield. The high yield market is stressed. It was overdone. The economic data is not coming in strong enough. Earnings are probably going to taper off a bit or fall because as long as the dollar remains stronger, right? So the earnings expectations, the consumer side of the economy is not picking up to the point that justifies some of the junk debt valuations. Now, we know the wholesalers go out to branches and talk to clients and whatnot, say, the credit spreads were tighter back in 2006, 2007. Yeah, interest rates were a lot higher then too, right? And who's to say that we would see credit spreads go that low again? Why should they? They were overpriced. Things don't have to go back to those levels. They don't have to go back to any level. Remember, they were never at those levels before. We argued a couple of years ago that spread-wise, this might be it for junk, and that's pretty much been it for junk spread-wise. They only have one way to go here, and that's wider. And with oil prices low, and putting pressure on the oil drillers and exploration companies, service companies in the junk market, we would not be surprised to see sometime this year, whether or not the Fed raises rates, see defaults start to creep up there, or debt restructurings. That's going to weigh on that market. So again, it's all suitability driven. But unless we were very aggressive and sophisticated, we understood credit risk and whatnot, we would rather go out to that 15 or 20 year area of the curve, depending on your product and your risk tolerance, to pick up yield. And remember, at least our opinion is the farther out you go, the better credit quality you want to have. You don't want to take a large amount of credit and duration risk. We don't think duration risk will come back and bite you anytime soon. There's a demand for bonds out there that's almost insatiable. Color we were getting from desks even before the number that there were plenty of buy side requests, plenty of offer wanteds, and very few offerings out there. We were reading commentary before we came on the air. People calling for this great rotation. Rates rise. People won't like the low bond prices. The falling by buy equities. It's apples and oranges. How many people trade their minivans in for a Ferrari, especially when they have 3 kids, right? So you have an older population. They want income and preservation of capital. They want bonds, right? Then you have the institutional side of the market: central banks, money-centered banks, investment banks, pension funds, insurance companies who need to own bonds. They can't say, "Gee, stocks are cheap. I'm going to take all my reserves and put them into equity." They can't. Regulations say they can't. Prudent investment and risk management says no as well. So the bond money is stickier than you think. That's all we have for tonight. Rates will probably be low for the rest of the year. How much of a boost it gives to equities? Maybe from a TINA basis, but we don't think the Fed can talk down the dollar enough to improve the earnings picture. So it's going to be kind of the rest of the year. We'll have low rates, most likely, somewhat lower earnings, most likely. We're not sure if job growth can stay in the 200,000 a month range. Right now workers are being hired because they're the cheapest option in a lot of cases. Does that pace of job growth keep up, especially if exports fall off? Remember, even the small cap, domestically focused businesses, a lot of them, their domestic focus are providing product and services for multinationals. So what the multinationals are going to do, to the smaller companies internally, they say we can't afford you right now, or we want to keep using you, but we want a lower price. So no one's completely isolated or insulated from the global economy. And with that said, again, that's pretty much all we have. Use models at your own risk. Use them as a basis. Don't use them as the end all and be all. Don't believe the hype about rising rates and things are taking off and things are wonderful. Things are okay. We're not heading towards a recession in all likelihood, but we're not heading into a situation where the Fed's going to be jacking rates anytime soon. And Europe, Japan, China, Latin America, with the exception of maybe Mexico, are all messes at this point. And it's going to take a lot more than negative interest rates to fix. And with that, we'll end here. If you have any questions, call us during market hours, although I am kind of in and out this week. My wife had surgery, so I'm taking care of her. She is my first priority. But I can be reached on my cell this week at 570-424, 570-234-6350. You can try my office, and I'll try to get back to you. It's 570-424-1555, or email me. I check it quite frequently. Thomas.Byrne, that's Byrne, at WS, that's Whiskey Sam, the word and then M as in Mike.com. It should be Whiskey Sierra, but I'm rushing here. So Thomas.Byrne at WSandM.com. With that, have a great night. We'll be back in the office next Monday. We'll be back on the air next Wednesday. And enjoy the low rates. Goodbye.